You'll be delighted to hear that it's getting quiet as we approach the festive break and the end of calendar 2017, but news-starved investors won't quite have to go cold turkey in the week leading up to Christmas. On the macro side, keep an eye open for the latest GfK Consumer Confidence Indicator for the UK, which is due for release on Thursday, the 21st of December. As we can see here, the reading slipped back to a post-Brexit low of -12 in November, which probably isn't exactly what the retailers wanted to see. Adding a second line to the graphic, the UK General Retailers Sector Index shows that the industrial grouping is pretty sensitive to how consumers are feeling, which obviously frankly makes sense. Barring any unscheduled trading statements, our first real look at Christmas trading on the UK High Street will then come from Next, with its festive update on Wednesday the 3rd of January 2018, and we'll look ahead to that in our next weekly video. For the moment, however, company-wise, there are two main features due in the week ahead. The first is what could be a tempestuous shareholders meeting on the 19th of December at the London Stock Exchange Group, where 5% shareholder TCI is trying to oust company chairman Donald Brydon for what it sees as his mishandling of the way in which the succession to now ex-chief executive Xavier Rollet was handled. As we can see here, the LSEG's shares have been a little bit becalmed of late, though whether that's due to this corporate governance ruckus, ongoing concerns over what Brexit may or may not mean for the UK's financial services industry, or simply a pause for breath after a stunning share price run, well, that all remains to be seen. The second scheduled statement is the one that could cause an even bigger fuss, and that's the fourth quarter and full year results from FTSE 100 cruise ship giant Carnival. The release is currently scheduled for the 18th of December, but that's still subject to revision, so the date may change. Keep your eyes open. In 2016, Carnival shares started badly and then recovered strongly. In 2017, it's been the other way around. They began well, but have rather lost steam in the second half, as we can see here. Three possible reasons for that are Hurricanes Harvey, Irma and Maria, which in September wreaked havoc across Florida and the Caribbean, both big destinations for cruise ships. Do note, however, that rival ship operator Royal Caribbean shares motored higher after its November figures, which beat expectations, despite what it said was a $55 million hurricane hit from lost revenue and higher costs. A drop in fuel costs seems to have helped a bit. Another peer, Norwegian Cruise Lines, has been drifting in similarly listless fashion to Carnival, so let's see what the update brings to the London and New York listed owner of the Carnival, P&O and Princess lines. When it comes to the full year numbers, analysts are looking for sales of $17.4 billion compared to $16.4 a year ago, and earnings per share of $3.70 against $3.73 on a stated non-adjusted basis. Now that was based on a fuel price of $370 per metric tonne for the year and a dollar sterling exchange rate of $1.28. Watch those inputs for any guidance given for 2018 as well. For next year, analysts are expecting a 6% increase to $18.4 billion in sales and a 16% jump in earnings per share to $4.29, as we can see here. Thank you for watching, and I look forward to seeing you next time.